This is Business Weekend with Ross Greenwood.
Hi and welcome to Business Weekend. I'm Ross Greenwood. It's great to have your company. Coming up on the program today, Qantas Chief Executive Alan Joyce is on the program talking about the future of the airline and how long he's committed to stick around.
I think it's an amazing company, amazing people, amazing customers, and I'm disappointed what's happened in the last few months, and we will fix it.
Now this week coming, it's the Job Summit, and one man who'll be there is Rob Scott, Chief Executive of one of the nation's biggest employers, Wesfarmers, owner of Bunnings, Officeworks and Kmart. But Rob Scott says the current enterprise bargaining system is broken. Also on the program, just after 18 months when it was urged to sell the Lytton oil refinery, Ampol made a cool $443 million from it in the last financial year. We speak with Chief Executive Matt Halliday.
What Lytton's profitability means is we've been able to make product, if you like, domestically in supporting Australia's fuel security.
So all of that and plenty more coming up on today's program. But look, first, let's start with Qantas Chief Executive Alan Joyce. He thinks there have been more calls for him to resign than any other Australian chief executive. It all goes back to 2011 when Qantas was in dispute with aviation unions and ultimately he shut down Qantas's operations. Now it's about the national carrier's response to the COVID shutdown and the present crisis around late or cancelled flights and lost bags. I put all of this to Alan Joyce in an interview this week, including his future at the airline. Okay, so let's then go to your customers, right? Number one, a lot of those people had credits, $1.3 billion in credits from COVID flights that were cancelled that still have to be sort of, if you like, made good on.
Well, they have.
Yes.
So actually, because there were 5 lockdowns, the first lockdown generated nearly $1 billion. Actually, the total amount of credits grew to $2 billion.
But of course, many of those people now coming back to make those credits either found it hard to get a flight or hard to get a flight at the right price.
Well, that's not true, because of the $2 billion in credits, $1 billion has already been used.
Yes.
At $80 million a month is being used at the moment. So people are running through those credits very fast.
They've got a deadline on those credits in many cases.
Yes, but we'll easily get there at this rate if we do $80 million a month. And we're going to offer a concierge service, which is going to come online now because our call centre is performing better than before COVID, to allow people to have an easy access to use those credits. In addition to the credits, we've refunded $2 billion to our customers. We're way ahead. You know, if you were in other airlines, you lost that money. Qantas has actually been really good, not only at keeping that money for our customers, but getting our customers to use it.
And the final thing about this is also the price of airfares. Yes. One wonders again, with capacity coming out, whether you're trying to get customers used to the idea of higher airfares into the future. Because remember that when there was fierce competition, you always claimed that airfares were way too low as a result of particularly international flights, government-owned airlines subsidising airfares.
One of the reasons, well, not quite on that again, Ross, domestically, what we have been doing is actually the catalyst for low airfares here, because we created Jetstar. I was the founding CEO of Jetstar, and actually what we're saying this year, there's going to be extremely low airfares still in the market. Jetstar will carry 13 million people, 5 million below $100, 10 million below $200. They're airfares that weren't there 20 years ago before Jetstar. When Ansett and Qantas were flying, you'd be lucky to get any airfare below a few $100s. So here we are 20 years later with all of that inflation, and we're offering airfares that are cheaper than taxi rides. So Australians have benefited from what Qantas has done in low airfares and will continue to do so. What we are saying, though, is that we do have to cover this oil price like all businesses do. And we are seeing oil being 80% higher this quarter than it was before COVID, 60% in the year. We've got a $1 billion extra to pay this year than we did in 19 with less flying. So we are saying that the airfares have to go up, or RASK. It could be C factor as well. Jetstar is doing it through increased C factor, extra seats that are full. It has to go up by 10% domestically to cover that, and 20% internationally to cover that. And every airline is faced with the same dilemma of having to try to recover those costs, because after $7 billion of losses, no airline can digest that extra cost.
Okay, so with this result today, the final result, are you saying to the market, to your customers, to your staff, with through COVID. We're actually now at the end of this, and it's actually a better Qantas and a better airline industry into the future?
I'm saying that we're coming out of COVID as a lot better airline. We've got an airline that will have new aircraft. We've ordered 300 of them. An airline that's going to do Sunrise. An airline that's investing in product. New lounges we announced today. New routes. Our biggest international network that we've ever had. A bigger domestic network that we've ever had. We're rewarding our employees with 200 million of non-EBA bonuses that they will get. We're rewarding our customers with more frequent flyer seats, and we're doing a lot more initiatives on our loyalty program. But if you're asking me, is COVID over? I don't know. Yeah. I hope it is, because I think we all thought probably at the start of the year it was, and then we've had this run. But are we better positioned to cope with it? Absolutely. Are we building more robustness into our schedule to cope with another wave if it occurs? Absolutely. So we're hopeful that we've learned the lessons of the past and we won't be hit twice by an unexpected significant COVID increase. But who knows where COVID goes.
Okay, just a final one for you, and that is that in 2020 it was expected that you might retire. In the centenary year, you'd have actually accomplished an awful lot. Sunrise would have been achieved. You're still here now. And this has taken a toll on you. That's got to, it's, you know, the personal attacks, all that type of stuff, they happen. Just explain the toll it's taking on you.
You know, I'm first of all, I'm really passionate about Qantas. So when the board asked me 3 years ago when we raised equity, because it was important to the market, that I committed to stay until at least the end of 23 to deliver on the recovery programme, to get the airline through the worst crisis in 100 years. Of course, I had to say yes to that, because I am passionate about this company. I think it's an amazing company, amazing people, amazing customers, and I'm disappointed what's happened in the last few months, and we will fix it. But I'm really passionate about making sure it comes out of this better than it went in. And I'm very passionate about projects like Sunrise, which is world leading. No other airline in the world is doing that. I'm very passionate about the product we're going to offer. It's world leading. It's the best in the world. I'm very passionate about our people. They're world leading, the best in the world. At the same time, I know it's a high-profile job, and I've gotten these attacks in 2011, in 2013. When we put vaccine requirements in, I had the anti-vaxxers going at me. So it's continually the other side of the job. But the positives of running the most amazing company in the country, the most amazing Australian icon, greatly outweigh all the brickbats that you get from other people who are just noise in the background, and we won't let them distract us.
Alan Joyce, always good to chat to you. Many thanks for your time today.
Thanks, Ross. Appreciate it.
Yeah, some quite remarkable personal insights into being a chief executive of a high-profile job like Qantas from Alan Joyce there. Well, another company that's felt the effect of COVID-induced absenteeism and skills shortages is Wesfarmers, owner of Bunnings, Kmart and Officeworks. Renowned for its discipline with capital, Wesfarmers' patience must surely have been tested in the past 2 years as it battled store closures, absent staff and volatile markets. This week, Wesfarmers said profit fell 2.9% to $2.35 billion. But like so many other companies, its second half was much, much better than the first. I spoke with Chief Executive Rob Scott from Perth a little earlier.
Well, Ross, I'm really looking forward to going to the Job Summit, and I guess I see myself as being a voice piece for our 100,000 team members in Australia, and that is really focused on a couple of things. It's trying to find a way that we can unlock some of the blockages around enterprise agreements, and that is so important for our businesses to drive productivity and ultimately deliver higher wages for our team members. That would be my first message. The second message is that I think there are some fantastic short-term wins that we can achieve out of the Job Summit, and addressing the critical shortages of skills and workers in Australia at the moment is an important one. So getting immigration going again, getting more skilled migrants into Australia, and improving some of the visa backlog problems that are holding us back at the moment.
Okay, so the immigration and the visa issues are issues that we have covered here on the program. One we haven't covered is enterprise bargaining agreements. Now, you've said, and I've seen it reported, that you say they're broken. What is actually broken about enterprise bargaining?
Well, just for the benefit of your viewers, the enterprise bargaining process is really about companies and business sites working together with our team members at those sites to come up with ways of adjusting work practices and sharing the benefits in terms of higher wages. And the intent of enterprise agreements is just fantastic. The problem is the technicalities. There are certain technical rules such as the Better Off Overall test and the way that they are interpreted, and some of the structural impediments to agreeing enterprise agreements that have just caused the whole system to break down. So as an example, in Bunnings we had an agreement that was going to lead to higher wages for 98% of our team members, and for the 2% that weren't going to get higher wages, we agreed to compensate them, but we could not get that agreement approved for technical reasons.
So, in other words, there's frustration on your side, so surely there must be also frustration on your workers' side as well if they can't qualify for perhaps those wage increases.
Absolutely. There's an enormous amount of frustration from our team members, and the great intent of an enterprise agreement is that they don't go ahead if the workers don't vote in favour of them. So enterprise agreements, when they were originally set up, were about empowering workers, but at the moment they're totally disempowered because the process just isn't working. But look, on the positive side, Ross, these are issues that everyone seems to understand and can be corrected. So I am optimistic that we can come out of the Job Summit with some solutions there.
One thing you'll hear, especially from the ACTU, from some Labor members as well, is that business is taking a bigger proportion of profits, that wages, real wages, are falling right now, that they're not keeping up with the level of profit growth. How do you respond to that?
Well, look, the data over the long term very clearly shows that productivity is the only way to sustain real wage growth. There has been some, distortions in the data of late due to high commodity prices that have shown in some areas profits go up due to simply higher commodity prices. And wages may not have gone up as much as commodity prices, but I think we all realise that one of the most dangerous things that we could do is just flow wages up and down with commodity prices. So that is distorting the statistics. The Productivity Commission has come out very clearly explaining the link between productivity and long-term real wage growth. So I think if we can focus in on ways of improving the competitiveness of Australian businesses, driving productivity, then we will see higher wage growth.
Okay, I want to go to your results, because when I look at Bunnings, I look at Officeworks, I look at Kmart, it was a year, almost a financial year of two halves. The second half incredibly strong, the first half with lockdowns, absenteeism, really quite poor. But it does show the power of those businesses to roar back to life. I was just looking at, Bunnings, I think return on capital, which is astonishing. I thought BHP shot the lights out with 45%. This is 77% return on capital, down from 82% last year. I mean, it really is quite an astonishing business in terms of returning your shareholders significant amounts of money.
Oh, that's right. Look, Bunnings is a fantastic business, and over the last 3 years, Bunnings has grown sales by 35% or $4.6 billion and grown profit by 40%. And not only have we grown the business, I'm sure you'd agree that we've invested an enormous amount in the communities around Australia. We continue to pay our team members when there wasn't work available through the lockdown. So we're definitely managing this business for the long term. But I guess Bunnings benefits from the very long-term focus that we have in Wesfarmers. If you go back 10, 20 years ago, Bunnings wasn't generating those kind of returns. So the opportunity for our other businesses is really to play that long game, invest in the future, and hopefully one day they can be achieving similar returns.
Okay, so the one thing about Wesfarmers people need to understand is you've always been a diversified portfolio of assets, and it's very hard when Bunnings is so big and growing so fast, or even Officeworks as well, to have something come along in that business. Explain to me the Mount Holland lithium business. You also made other plays in the lithium industry as to why you went so aggressively into that space.
Well, I guess what gave us the opportunity to invest in Mount Holland is that we have a phenomenal chemicals, energy and fertiliser business with very deep experience in chemical processing and developments here in Western Australia. And our WesF business generated 40% growth in earnings and delivered $540 million of earnings before tax this year. So that gave us the confidence in investing in the lithium project. And look, this is an exciting project. We're currently currently investing nearly $1 billion in terms of the development. We also have the capacity to increase the scale of the development over time. And this is a business that we hope will generate significant cash flows for the group that will benefit our shareholders over the decade ahead.
Okay, and this is about Australia becoming a key lithium player, not just a producer of the ore, but also a processor, so that we ultimately can be a supplier to the world.
That's correct. So, look, if you look at the moment, and prices are quite buoyant in the lithium space, and we've even seen prices of the spodumene concentrate, so that's the concentrated ore, sell for $5,000 a tonne plus. But the lithium hydroxide at the moment is selling for prices 10 times that or more. Now, clearly prices are very elevated. They may not stay there forever. But we think that it is a fantastic opportunity, not just for Wesfarmers, but for Australia to get more involved in the value-added processing. And we do have some unique advantages in Western Australia, the quality of the ore bodies and competitive chemical manufacturing within Kwinana that should set us up well.
I'll tell you what, Rob Scott, always good to chat to you, and many thanks for your time today.
Thanks very much, Ross.
Coming up after the break, outgoing Chief Executive of Scentre Group, the Westfield owner, Peter Allen, and his incumbent, Elliott Rusanow, on the future of shopping centres, plus the benefits of fuel security with Ampol's Chief Executive, Matt Halliday. Thanks for being with us here on Business Weekend. Shopping centres, which were so affected by social distancing, staff shortages and limits on population movements, are back in business. Big time. This week, Scentre Group, which owns the Westfield shopping centres, saw its half-year profit ahead by 17.5% to $540 million. Now, this week, I spent some time with the outgoing Chief Executive, Peter Allen, and also the incoming boss, Elliott Rusanow. Peter, Elliott, many thanks for your time. Peter, can I start with you? Going back to 2.5 years ago, could you have imagined that your business, that the Westfield centres around Australia and New Zealand, would be in this sort of health right now?
Yeah, definitely I could have imagined it. I would have been, I suppose, a little bit shocked in terms of how quickly we've been able to get out of the pandemic. A lot of that has to come down to the health and the government in terms of the support that they've given to the population. But in effect, what we did do is we did focus in terms of thinking about the future. So even through the pandemic, we wanted to think about the future. How can we get better? How can we engage with our customers to make sure we didn't lose that opportunity? And I think what that has shown is that our customers are coming back because we are providing that destination where people want to come to.
So, Elliott, going forward, you as the incoming chief executive of this business, you got $4.5 billion worth of building in the pipeline to be done, which says something about your group's view about retail and consumer sentiment and confidence into the future.
Yeah, I think, as we articulated, our ambition is to be essential to people, their communities and businesses that seek to interact with them. And on average, we have around 500, we're guiding for this year, 500 million customer visits. In essence, we're competing for people's time, and that's where we see a tremendous opportunity to grow. At this point, we have close proximity to 20 million of the 31 million people that live in our two markets, Australia and New Zealand. And we have ambitions to grow that to be closer to that 31 million. And of the 20 million that we're in close proximity to today, 10 million come on average once a week. And so there's a great opportunity to grow that 10 million to the 20 million and hopefully closer to the 31 million over time.
Because as online, Peter, really emerged during the pandemic, a lot of people might have said, well, now there's a competition for time. Do we want to come to a shopping centre? What is the experience I'm going to get? The evolution of the shopping centre has also been a part of the story of the pandemic, isn't it?
Yeah, it has, but it's also being a part of the story for the start of shopping centres. You know, you go back to the agora of the Greek marketplace, you know, that evolved in terms of the place where not just people sold goods and services, but also where people came as a community. I think what we've been able to do as an organisation is to be understand where customer trends are and to be able to leverage those trends to be able to say where are people spending their money, where are people spending their time. And so if you think about our spaces, you know, when we started Scentre Group, we had 10% of our stores were experience-based. Today, 43% of our stores. We know that people are spending more money on experiences and their own health and beauty than they are on stuff. And so you've seen the nature of our businesses change.
So how do you judge that as you're trying to develop where shopping centres go to in the future, where you actually build in the future, how do you make that judgment as to what experiences people will want? Or is that really up to you, or simply the people who take the risk and open their stores inside your shopping centres?
I think a lot of it is data driven in terms, and it's our choice in terms of which business partners we want to partner with. You know, I think that's the beauty, is we're curating a mix for each centre, so it's not cookie cutter. Westfield Mount Druitt is very different than Westfield Coomera, for example, in Queensland. So what we are able to do is use first party data in terms of understanding our customer a lot better, to be able to ensure that we look at macro trends in terms of where population growth, where density is going to be. We've been very fortunate that the Westfield centres that I inherited as Scentre, or Scentre Group inherited, are key on the key transport nodes, close to population, greater density around us. So what we're able to do is to leverage off that, leverage off the data, and then create a unique centre for that population base.
Just explain to me about the number of new stores and just the makeup of those stores.
Yeah, so we introduced 500 and just under 580 new businesses into businesses growing, of which 108 are new brands that have never done business with Westfield before during the 6-month period. And all of those leases were done on the standard terms of CPI plus 2%. Average lease term is 6.8 years, so they're making a commitment for a long duration for operating in our platform. And the reason why is because they're able to access a customer in the most efficient way, which means that they can interact with that customer in a very profitable way. And we've seen that in the last in the second quarter of this period, the last 3 months. Sales growth for specialty retailers compared to 2019, so pre-pandemic, were over 13% higher. And for the total portfolio was just under 11% higher. So sales are outstripping the CPI plus 2%, which means that those businesses are actually becoming more productive in our environment.
Peter, next week the government has a jobs summit where it's going to address key issues, which include skill shortages, which is including where Australia grows into the future. Now, many of your retailers inside your stores would be struggling to get staff right now to do the basic things. How do you overcome those shortages of basic skills inside your shopping centres?
Well, I think the only way that we can do is to increase immigration and to increase the way and the reason why people want to come to Australia. I think Australia is very fortunate that we don't necessarily have to pay for immigration because we've got such a lucky country and such a great environment for people to live and to work and to play. I think we need to push that a lot harder, and I think unfortunately through the pandemic we've had to do the right thing in terms of closing our borders. But now's the right time to be able to increase that immigration, basically not just to increase it a little bit, but to really catch up in terms of what we've missed out on. Because in respect we still have the natural population growth in Australia. I think we just need to accelerate that, because not only do our retail business partners not have the capacity, but even Scentre Group, we don't have the full capacity in terms of staff to be able to deliver the services and the excellent, I suppose, position to be in terms of experiences at our centres that we would love to be able to do.
So is there an argument here that you raise that issue about giving a financial incentive for people to come to Australia? Have we got to that point yet?
We possibly do, because I think when you look at other countries, and I think this has to be a part of the review, is because we are competing for talent as a country. And so therefore you look at other countries in terms of what they're doing to be able to access that talent. Now, other countries aren't as beautiful as Australia in terms of being able to bring people in, but we may have to be able to provide an incentive for bringing people into Australia.
It's interesting. Tax incentives? What sort of an incentive? Not a cash payment, surely?
Well, potentially it could be. I think that that's something that the government has to work out. But, we look at other countries where they are providing cash incentives to be able to bring immigration into that country. That is something we have to review. Potentially, maybe it is a permanent residency. How do we change the nature of that? How do we look at bringing more students in terms of areas which we need to have those skill level in, and to be able to give them a quick access and path to be able to have permanent residency in Australia.
Now, Peter, you're stepping down as the Chief Executive of Scentre Group. Just remind me, how many years have you been with Scentre and Westfield overall?
Yeah, I've been fortunate to be the CEO of Scentre Group for just over 8 years, which has been great, to be able to set up a new business, brand name, culture, focus on the customer, but I've been with Westfield for 27 years. 27
years, that was a lot of phone calls from Frank Lowy early in the morning, wasn't it?
It certainly was, yes.
and as you come into this, Elliott, I mean, if 8 years later, what would you imagine that Westfield will look like as you leave this business perhaps in the same time?
I think that the business evolves from being shopping centres and retail focus to being something that captures people's time, and for many hours of the day, hopefully 24 hours of the day, 7 days a week, every day of the year. And the existential growth of that by using technology to access more people than we have today. So, if we look back in 8 years' time, our centres will be the places that people want to spend all their time at.
And how many more centres do you reckon there'll be in that time?
I don't know.
Go on, give us a rough guess.
It's very difficult to know. It all depends on where population grows. But I think it's fair to say it'll be more than where we are today.
There you go. Elliott, Peter, many thanks for your time.
Yeah, thanks, Ross.
Yeah, we just wonder whether you get the sense that Elliott Rusanow might be opening up the debate about trading hours yet again. Now, one trend from the profit reporting season is that despite the world's efforts to decarbonise, it was fossil fuel businesses, so coal miners and petrol refiners, that shot the lights out in terms of profit growth this season. Among those beneficiaries, Ampol, which just 18 months ago was considering closing its Lytton oil refinery in Brisbane. Had it done so, it would have made a big mistake. In the past year, that refinery generated an operating profit of $443 million. In other words, 9 times better than a year before. This week, I spoke with Ampol's Chief Executive, Matt Halliday.
With the benefit of hindsight, you look to the quarter and the half that Lytton's just had, and it's been an incredibly important contributor to our profitability. It's an incredibly important contributor to our integrated supply chain and fuel security for the country. It's always hard in the heat of the moment, in the heat of times when Lytton lost $145 million in 2020. Times were pretty tough, but when you work through the steps we took to keep the asset open, no doubt it's playing an important role today and will for some time to come.
As a chief executive, as an executive team, how do you balance this out? $145 million, you've got shareholders on your back, you've got stockbroking analysts on your back, just basically trying to urge you to do something. But long term, it's proven that those calls at that time were wrong. So how do you balance this out over the long term for the business?
Well, it's always incredibly important to take a long-term view of the business, to look through short-term volatility, much as it was pretty extreme during COVID times, as we all remember, but take those decisions that benefit the long-term strategy of the business. Lytton plays an important role for us. It's increasingly stepping up to play an even more important role, and longer term, the nature of the asset, its location, the skills we have at Lytton are going to play a really important role from a transition point of view as well.
But then even the federal government had stepped in to ensure that it was kept open. It put money on the plate effectively to ensure it was kept open. So that's also important for Australia's fuel security.
Absolutely. Lytton's an important part of Australia's fuel security. That's what the conversation with government was about back then. And I'm really pleased that Ampol, as an independent Australian company, was able to embark on the discussion with government, understand the fuel security objective and work to find a solution that could address Australia's fuel security needs, which are very important to Ampol, and also the needs of our shareholders. I think really pleasingly, the arrangement that was put in place was an arrangement that only takes effect when margins are very low, and now that margins have recovered, obviously no support's being received.
So Lytton has made a lot of money despite oil prices being higher because it could pass on those costs to motorists and to industrial users of your products. So then do you treat the spike that we've seen in oil prices as a short-term aberration, or do you treat it as something that you plan for into the future?
Look, so Lytton and refining is a cyclical business, always has been and will continue to be. We've seen an extreme supply side shock in the second quarter. Russia's invasion of Ukraine, of course. China has heavily reduced its fuel product exports into the region, and they have, on top of low inventories going into those geopolitical events, has really tightened up the refining market. So we look at that, but we look at it as a cyclical business where you're going to have some good moments and you're going to have some moments where obviously in 2020 we lost a lot of money. Lytton is effectively a make versus buy decision for Ampol. So Australia imports around 75% of its fuel needs, and so is heavily linked to international prices, and those international factors really drive fuel prices in Australia. What Lytton's profitability means is we've been able to make product, if you like, domestically, in supporting Australia's fuel security, but more efficiently and economically than buying from international markets.
Okay, given the higher prices of fuel, have you seen any change in behaviour? Because during the pandemic, everybody jumped in their cars and drove. Have you seen any change in behaviour since the fuel prices have increased?
Yeah, so certainly the shock that we saw and very high fuel prices that we saw in the second quarter put a lot of pressure on consumers, and you do see an element of demand destruction, particularly in retail fuel, when you have those features at play. We saw that with our retail volumes down 5.8% during the first half, and obviously we saw those pressures applying in the second quarter. They will play out a little bit as fuel prices have come down in the third quarter so far to date. But we expect we're going to continue to see that international volatility linked to those geopolitical events.
Okay, tell me about a story that I heard last week, and that was that during the period of the gas crisis in Australia, where gas was not able to be used affordably to generate electricity, that some of those generators started to use diesel to actually generate the fuel. Now, that seems nuts to me in an environmental world that we live in right now, but is that true? And is it true that the volumes of diesel you sold during that period of time literally went through the roof?
Yeah, so certainly there has been a lot of spot diesel demand for power stations and backup power. As you would expect when you see an energy crisis of the magnitude that we saw during the second quarter and some of the fairly significant steps that the regulators took to ensure an orderly market. You've seen people place a lot more focus on fuel security. I think it underlines the importance of balancing transition with fuel security, and when we talk about an orderly transition, we need to make sure that we don't lose energy security along the way, and that's where an asset like Lytton's really important, and it's really important that we have sufficient power, sufficient fuel, sufficient backup as we're making the transition to renewables through the energy transition, and we're very focused on making sure we get that balance right, and we support Australians today but also tomorrow.
But I get that, but then even as a company that makes the diesel that's being sold, doesn't it seem nuts to you that that is the situation? And you're in a transition to try and reduce emissions in the long term. It seems crazy to me that we're burning diesel because the gas is either not there or too expensive to be used as a transition fuel.
So that demand really shouldn't be there. If we get a plan in place, which I think the various governments are working their way through and the various industry players to ensure we have a coordinated, orderly plan for transition, you shouldn't need to have those steps being taken. But it's a timely reminder for the country that we can't afford to lose energy security as we're moving through this transition. You look to what's happening in Europe at the moment and you look at the transition they're going to make through a very challenging winter, and we don't want Australia to replicate that experience.
Okay, then come back to the way in which you're making the transformation, because your transition, right now you're rolling out electric chargers both for the home but also inside your own petrol stations, your own fuel stations. So just explain, even a good half like this means that you've got more money, more capital to be able to participate in that rollout. Just how far and how fast can you do this?
Yeah, so we've been very clear that one of the key advantages that Ampol has today that underpins our market position is the strength of our network. We've got a branded network that's just over 1,900 sites spread right across the country. And that's an incredibly attractive asset as you look for building the network of the future. Has different requirements, but it can leverage off that strong infrastructure position we have today. And so that means in serving our customers as they move to electric vehicles, which is going to be the solution on the light passenger, light commercial side, they want to be able to charge not only at home, which will be an important part of the solution, but also on the go. And that's where our forecourts are incredibly well positioned to play a role in giving customers the comfort that when they're out and about, they can fast charge their EV and keep moving.
Matt Halliday, always good to chat to you. Many thanks for your time today.
Thanks, Ross.
Coming up after the break, Unilever invests in ESG certification amid rising price hikes. Plus, the Australian's Adam Crichton on the government's controversial superannuation reforms. Thanks for being with us here on Business Weekend. One of the terms you're going to increasingly hear is B Corp. B Corp, that's what it is. In effect, this is an organisation that's been assessed by a group called B Lab in America. It certifies companies based on their social and environmental performance, accountability and transparency. And how do they balance those aspirations with making a profit that's satisfactory for shareholders? Well, the Australian arm of one of the world's biggest consumer goods companies, Unilever, recently achieved this rating. And Edward Boyd spoke with its Australian-New Zealand Chief Executive, Nikki Sparshott.
B Corp is joining a community of organisations that want to definitively prove that you can make a dollar and make a difference. So it's about holding ourselves to high standards of environmental performance, social performance, accountability and transparency, whilst at the same time delivering great financial results. So it is really about having that triple bottom line impact, planet, people, profit in action.
How significant is this?
For us, this has been an achievement 2 years in the making. You have to go through an incredibly rigorous process to really demonstrate that you are operating at high standards and serving multiple stakeholders. So working for not only our team members, the community, looking at the environmental lens, government, and really the governance that we put around producing products ethically and sustainably. What I'm most excited about, though, is that our consumers, the community, is showing a really heightened interest in brands that are purposefully and sustainably produced. So 90% of people now are looking to make that part of their purchase decision criteria, and 30% of them are saying it's the number one reason they're choosing one brand over another. So we're really excited about being part of this B Corp community.
Yeah, you've mentioned some of those brands. How important is it, being a B Corp company, to sort of differentiate yourself from some of the other competition that you might see on the supermarket shelf?
Yeah, I think what's going to help is that B Corp is going to be a shortcut for people to know that when they pick up one of our Unilever products and it has a B Corp logo on it, they can feel incredibly confident that not only is it of high quality and high safety, great tasting and high performing, but it's been produced in a really sustainable way, in a really ethical way, that not only has a regenerative impact on the planet, but also, I guess, contributes to a more fair and socially equitable world. And that to us matters a lot.
A lot of supermarket chains now have their own home branded products. So how do you get your products to differentiate themselves when they're often at a more expensive price point than the home branded competition?
Yeah, I think at the end of the day, we hold ourselves to account to deliver amazing products that people want, that make a small difference in their life every single day. B Corp certification for us is not about it costing the consumer more. It is about just being that symbol of a product that has been very purposely sourced, manufactured, transported, and then can be consumed in a way that is really, really well considered. And we've spent a lot of time removing inefficiencies in our business so that we can make sure that when we bring these B Corp products to market, it doesn't cost the earth, pun intended, doesn't cost the planet, and also is reasonable for our consumers.
And now you've got B Corp. What does it take to maintain that level, that certification?
Yeah, so look, we've been on this journey of sort of triple bottom line imperative for some time. It took us 2 years to get B Corp certification, and it just now kicks off a process of continuous improvement. So we will need to get re-registered 3 years from today and just demonstrate that in all the areas that are important around environment, around workers, that we are continuing to make really strong progress towards that recertification.
There's a lot of uncertainty, economic uncertainty at the moment. How confident are you feeling as a Chief Executive?
Look, we're certainly living in volatile times, and we have done for the last 2.5 years. I also think that we will continue to see some of that volatility remain, over the next probably 18 months or so. What I'm encouraged about is that during the last 2 years we've seen the community, government, business just really fortify their efforts to make sure that we can actually focus all of our collective energies on doing things that actually do improve our environment, do improve our community, and actually shore us up to be able to deal with the enormous amount of change. But I think the last 2.5 years has also shown Australia is very resilient in this area and able to navigate the curveballs that come our way.
We've got rising inflation, we've got rising input costs. How do you manage those costs?
Yeah, so from, Unilever's a big company and we're not immune to these extraordinary challenges around cost inputs and freight and logistics and some of the others that we see coming our way. Again, it just comes down to making choices about flowing our energy and our efforts and our resources into removing the inefficiencies that sit in our business and just focusing even more on delivering high quality, safe, well manufactured products to our consumers. And B Corp, I think, just gives consumers and our retailers, as well as our own team members, that extra assurance that that is what we're doing every time we make a decision. Is it good for business? Is it good for society? It needs to do both those things.
Prices have obviously been increasing this year across the board, but how much have prices been increasing at Unilever?
So again, there've been input price rises, freight increases and a lot of supply chain discontinuities, and I think we are certainly seeing that in the inflation in the market. Again, I go back to the fact that at Unilever we're just really conscious about where we take those increases and how we do it in a way that is reasonable for consumers, but double down our efforts on making sure that we can deliver those high quality products consistently and without it costing the earth.
And what are demand levels like at the moment for your products?
It's really, really interesting for us right now. We're seeing some really strong demand, particularly for those brands that have recently been B Corp certified and demonstrate the push that we're seeing from consumers in particular to vote with their wallet for products that do deliver everything that they promise from a product point of view, but are also done so in a really ethically sustainable way. So we are seeing market share growth for those purpose-led brands in our portfolio.
One other thing is rising interest rates, and you're the head of Australia and New Zealand. New Zealand, the cash rate is quite a bit higher than Australia. Have you noticed any changes with consumer spending compared to when you compare New Zealand to the Australian market?
I think we're just going to see a continued increasing focus by consumers to be ever more considered in the choices they make about where they put their discretionary spend that's available.
Well, Nikki Sparshott, Chief Executive at Unilever Australia New Zealand, thanks for your time today.
Thank you so much.
Earlier this week, Treasurer Jim Chalmers laid out a vision to unlock billions of dollars in superannuation to help fund Australia's emerging high-tech industries in robotics, renewable energy, electric vehicles and more. It comes as the US late this week passed legislation to spend $52 billion to help build and grow semiconductor plants at home. Adam Crichton is the Washington correspondent for the Australian newspaper and also a Sky News contributor. Adam, thanks so much as always for your time. This begs the question, of course, as to whether government should try to pick winners out of industry, and whether this is the right policy to adopt.
Yeah. Well, certainly I don't think it is. I mean, just firstly in the case of Australian superannuation, I mean, since it was established, there's something called the sole purpose test, which I understand means that funds have an obligation, a duty to their members to get the highest possible return. And if you have government regulations there that are effectively interfering with those investment decisions, then that doesn't necessarily mean that the funds will get their highest return. That's the first point. And then I think the broader point is governments have a terrible track record of picking winners. And certainly I would imagine if it's the case of electric cars or those other industries that you just mentioned, it's going to turn out just the same. I know there's some chatter back home about giving banks some benefit from co-investing with super funds. I mean, I'm extremely against that. I mean, it's completely opposed to the reforms that emerged from the global financial crisis, which was all about keeping bank capital high. So I think that would be a big mistake. And just on the US, you mentioned the so-called CHIPS bill there, the semiconductor bill. Well, yeah, sure, $52 billion of that bill is for manufacturing of semiconductors, I should say, but $20 billion of that goes to one company, Intel, and the rest of it goes to two other companies. And these companies were already planning to expand their manufacturing. So naturally, if you're the CEO of Intel, you're wrapped by this. Of course, you're going to take the money. And of course, the whole industry is cheering because, it's $52 billion in their pocket from taxpayers and they didn't have to do anything for it, really. But the bill itself is actually $280 290 billion, I believe, or 280 billion, I should say, over 5 years. So, it's a huge amount of money, and only a very small share of it is actually going to chip manufacturing. The rest is going to all sorts of subsidies and research centres and even research to get to Mars. That's all very well, but it's got very little to do with semiconductor manufacturing.
And really, that's all about the shortage. So in some ways, there's a knee-jerk reaction to the shortage of semiconductors that is caused as a result of China being locked down. And also, it also goes back even to Donald Trump's period as president, where he was trying to bring industry back on shore to the United States to make the United States more self-reliant. So this is kind of part of a globalised sort of trend, if you like.
Yeah, look, that's certainly true. It is part of a trend. I mean, the share of global chips that have been produced by the US has been shrinking for some time now. The bulk of advanced chips are made in Taiwan. And of course, there are a series of long-term geostrategic vulnerabilities there with Taiwan. And so, it makes perfect sense that the US and Europe and Australia perhaps would want to build more chips themselves. But I'm just not so sure that throwing billions and billions of borrowed money, and of course it is borrowed because the US has a massive budget deficit, at companies is really the best way to go about it. It's also worth saying that the shortage of chips was also due to the lockdowns introduced in the West and the great havoc that they caused for supply chains around the world. It wasn't just the Chinese lockdowns. And so maybe it's worthwhile just waiting a while for the economy to get back to normal, so to speak, and then to think about how we might fairly efficiently try to onboard some of that manufacturing.
And there's a subtle but very important difference between the United States and what it's doing and what Australia's doing. In the United States, it's actually using the government funds, which are ultimately taxpayer funds, to subsidise the manufacture of semiconductors. In Australia, what Jim Chalmers is proposing is that the retirees' direct savings are used to try and, if you like, create the capital to build these new jobs of the future.
Yeah, well, look, I think that I would prefer the US method, actually, to be honest. It's a lot more transparent. When you have these rules that are, that are kind of off balance sheet, as Jim Chalmers is proposing, it can be difficult to see the influence of government. Actually, we saw that in the financial crisis, where you have these obscure rules about the various ratings that various loan tranches can have, and over the long term, it can have very catastrophic consequences. So I think the US method is better for the government to do it with its own money. It's more transparent. But even there, as I said, I think it's far too much money, and I'd be very surprised that it's going to increase the chip manufacturing as much as the US government would like.
Well, I'll tell you what, it should be a debate. It's an important issue to raise, because ultimately it is either the people's money or the government's money, which is the people's money anyway, and it's about the way in which it's allocated, which is always a part of the conversation. Adam Crichton, always good to chat to you, and many thanks for your time today.
Thanks, Ross. Thanks a lot.
So that's it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday. But don't forget, you can keep up to date with all the latest business news with our daily program Business Now, 4:30 p.m. and 10:30 p.m. Eastern Time. You can also recap Business Weekend and plenty more business news via our website, skynews.com.au. Thanks for your company. I'm Ross Greenwood. We'll see you next week.